Welcome back. The big story from overnight, the Fed members sounded hawkish as per the minutes of the FOMC meeting of December 14 and 15. But Wall Street has remained unruffled. To understand more about what to expect from the Fed in the coming days, Steve Englander, the global head of G10 FX Research and North America Macro Strategy at Standard Chartered Bank, joins us. Steve, thank you very much indeed for staying up for me. First up, what did you take away from the FOMC minutes?
Well, my key takeaways were slightly different than the markets. I think the market read it as being somewhat hawkish. It was a repetition of some of the hawkish themes that had emerged, during the FOMC press conference and some of the comments afterwards. I didn't see anything new, but reading the minutes carefully, it seemed a little bit more nuanced and balanced about upside and downside risks. And in particular, they didn't seem to emphasize very much how much further rates could go, just kind of leaving it a little bit open. Discussion of the economy was kind of downbeat. And, the discussion of inflation, as I said, was kind of balanced, acknowledging more than Powell had acknowledged that the numbers were coming in better than expected. Okay. But, it was market treated it a little hawkish. I would have treated it a little dovish.
Okay. What stood out for me was that the Fed officials seem unhappy that the market is pricing in cuts. Now, let me just read out this sentence to you. I'm quoting the minutes. Participants noted that because monetary policy worked importantly through financial markets, and unwarranted easing in financial conditions, especially if driven by a misperception by the public of the committee's reaction function, would complicate the committee's effort to restore price stability. So, how would you react to this? They are unhappy that the market is pricing in a cut.
Yeah, it was surprising. They unhappy about pricing a cut, unhappy about any kind of easing in financial conditions, which they also expressed there. But I think they're misreading the market in the sense that the market isn't challenging their reaction function. The market is challenging their economic forecast. Investors think a recession is coming, and that's going to justify the easing that they see. It's not that they're saying that the Fed will be dovish.
No, but I just looked up the market pricing. I mean, the CME FedWatch tool is still showing an expectation of not just one or perhaps even two rate cuts in 2023 itself. So do you think the Fed, in order to cool the market, will have to be even more hawkish and perhaps push up rates higher than what they are now saying?
Well, the Fed clearly wants the market to be aware of that possibility. To me, and our forecast is that the Fed does 25 in February and then stops. But it's also contingent on clear signs of an economic slowdown emerging. And, for us and I think for the market, there's a recognition that if the economy keeps going and if inflation remains high, the Fed is, probably going to continue to hike. But, there's an economic forecast that underpins the rates forecast, which is that the economy will show clear signs of slowing.
Okay, now let me come to the market. How do you see US bond yields moving? Is there still a chance that they can go higher towards 4%?
We think that they're going to rest, under 4% for some time. As long as the economy is downbeat and inflation is coming down, we don't think that there's going to be much upward pressure that could resume at some point in the future if the economy started rebounding strongly. But for now, we don't see what's going to push it up above 4%. I mean, obviously, given the volatility, anything can happen on a 1 or 5 day basis, but we don't see a trend there to go higher.
Okay. So your base case is that it's not going anywhere near 4%. Okay. What about smart money? Does it move towards Asia? After all, countries like India are not even dependent so much on US and Europe by way of exports.
Well, in some ways, this could be a bit of a reverse of last year, where U.S. came out okay, the rest of the world, was kind of hit hard. We expect China to reopen, and they're clearly intent on reopening. India is well positioned, I'd say, on the growth front and on, the trade front and its ability to deal with different, trading partners. And I think even Europe is coming in stronger than people expected, and the sort of energy vulnerability that was anticipated is doesn't seem to be showing up. So, it could be, not just India's year, but the rest of the world's year against the dollar if these trends continue.
Okay. Okay. What's your take on the dollar index in that case? It's actually dipped a bit after the minutes. Is it headed lower? What's the range for the dollar index for the next couple of quarters? What's the trajectory?
Well, as we've seen over the last year, and anything is possible in this world.
Yes.
Our forecast is that the dollar, continues to fall, and probably, isn't halfway done even with the kind of fall that it's going to take. It will take time, of course. I think we know the risks, in the sense that if inflation turns out to be stronger than expected, if there's a geopolitical deterioration, those are the forces that could take the dollar up. But if anything, I'd say, some of the comments from the, Chinese foreign ministry are actually sound as if they're trying to be conciliatory. The Ukraine war, unfortunately, is still going on, but markets have adapted to it. But there are risks.
Oh, yeah, those risks can push the dollar up, but your base case is that the dollar is falling and even half the fall is not done. Now to the rupee. Is the worst over? Is it likely to be at best a mild depreciation in 2023?
Yeah, in fact, there's some room for modest appreciation in line with other currencies against the dollar. We don't think that the rupee has that much further to go, maybe a little bit more in the short term. And we don't think it's going to be a leader in currency strength against the dollar, but it will be, among the set of currencies that are likely to appreciate against the dollar as the dollar weakens.
Okay, I'll underline that for our viewers. Could appreciate the rupee. Many people have the view that in the second half we could see a rupee appreciation. Some people even expecting 79. Well, finally, what's your own hunch? Will the Fed cut this year?
Look, it's actually in our forecast. I think it's possible. But again, I think that it depends. If we see the unemployment rate approaching 5%, I think that they will cut. They're not going to cut very fast. They're not going to be, take rates down to 2%. But I think the unemployment rate going up sharply will tell them that they've tightened sufficiently and maybe even over tightened given the nature of the lags. If the unemployment rate stays 4.25, yeah, their motivation for easing just isn't going to be there.
Taken, Steve, and that means we have to look for the jobs data that will come out on Friday. Thank you very much for staying up for us. Have a great 2023. Well, the second dip in the market has been bought. So as we wind up on Bazaar, it's green on the screen, and we have an interesting chart busters lined up for you.